Absorption costing and marginal costing are two fundamental costing techniques used in management accounting to measure product costs, value inventories, and determine organizational profitability. Although both methods accumulate production costs and support managerial decision-making, they differ significantly in their treatment of fixed manufacturing overheads. Understanding these differences is essential for budgeting, performance evaluation, pricing decisions, cost control, and financial reporting. The program emphasizes both approaches because each provides valuable but distinct perspectives on organizational performance and resource utilization. A central concept in marginal costing is contribution, which represents the amount remaining from sales revenue after deducting variable costs. Contribution measures the amount available to cover fixed costs and generate profit and is calculated as. Contribution is one of the most important concepts in management accounting because it directly supports short-term decision-making. It provides the basis for break-even analysis, profit volume analysis, limiting factor decisions, product mix optimization, pricing strategies, and special order evaluation. Products generating higher contributions contribute more effectively towards recovering fixed costs and improving profitability, making contribution analysis a critical management tool. The principal distinction between absorption costing and marginal costing concerns the treatment of fixed production overheads. Under absorption costing, all manufacturing costs, including direct materials, direct labor, variable production overheads, and fixed production overheads, are absorbed into product costs. Consequently, inventories are valued at full production cost, and fixed manufacturing overheads become part of inventory until products are sold. Under marginal costing, only variable production costs are included in product costs. Fixed manufacturing overheads are treated as period costs and charged directly against profit in the accounting period in which they arise. Closing inventories, therefore, contain only variable production costs, excluding fixed manufacturing overheads. This fundamental difference explains why reported profits under the two methods may differ whenever inventory levels change. The treatment of inventory significantly influences profit determination. Under absorption costing, when production exceeds sales, part of the fixed manufacturing overhead is carried forward within closing inventory rather than being charged immediately against current profit. As a result, reported profit is relatively higher because some fixed costs are deferred to future accounting periods. Conversely, when sales exceed production and inventory decreases, previously deferred fixed overheads contained in opening inventory are released into cost of sales, reducing current profit. Marginal costing produces different results because all fixed production overheads are recognized immediately as period expenses regardless of production volume. Consequently, profit under marginal costing depends solely upon sales volume rather than production volume. Inventory changes, therefore, do not affect the timing of fixed overhead recognition. The calculation of profit under each costing method illustrates these differences clearly. Under absorption costing, where cost of sales includes both variable and fixed manufacturing costs absorbed into inventory. Under marginal costing, where contribution represents sales less all variable costs, and fixed production overheads are deducted in full during the accounting period. Although both methods ultimately recognize the same total costs over the product life cycle, differences arise because absorption costing defers part of the fixed manufacturing overhead through inventory valuation, whereas marginal costing expenses all fixed overheads immediately. The relationship between profits under the two methods can be expressed through a simple profit reconciliation. If inventory increases during the period, absorption costing profit exceeds marginal costing profit because fixed overheads remain in closing inventory. If inventory decreases, marginal costing profit exceeds absorption costing profit because previously deferred fixed overheads are released from inventory into cost of sales. Where inventory remains unchanged, both costing methods produce identical profits since all fixed manufacturing overheads incurred are recognized during the same accounting period. Each costing method possesses important advantages and disadvantages. Absorption costing complies with international financial reporting requirements because inventories include all manufacturing costs attributable to production. It provides comprehensive product costs suitable for external financial statements and long-term pricing decisions, while recognizing that fixed production facilities contribute to manufacturing output. However, absorption costing may encourage managers to increase production unnecessarily to improve reported profits through inventory accumulation, potentially leading to excessive inventory holdings and inefficient resource utilization. Marginal costing, by contrast, provides superior information for internal decision-making because it highlights contribution and the distinction between fixed and variable costs. Profit depends solely on sales rather than production, preventing artificial profit manipulation through inventory changes. Marginal costing supports break-even analysis, cost-volume profit analysis, product mix decisions, special pricing, make or buy decisions, and short-term operational planning. Nevertheless, marginal costing is not accepted for external financial reporting because inventories exclude fixed manufacturing overheads, potentially understating inventory values and assets reported in financial statements. In practice, many organizations utilize both costing systems simultaneously. Absorption costing satisfies statutory financial reporting and inventory valuation requirements, while marginal costing provides internally focused information that supports managerial planning, performance evaluation, and strategic decision-making. Together, these complementary costing approaches enable management accountants to evaluate profitability from both financial reporting and decision support perspectives, thereby enhancing organizational planning, cost control, and overall business performance.